I see.
Even in the outside,
Yeah.
at the outside of the buildings, you cannot smoke.
I felt like a sinner doing that.
Did you do that? Okay.
Maybe.
Okay, because there are designated areas with, marked with blue lines and things like that. You can only smoke there.
Yeah.
Our rector, previous rector, hated smoking. So he did his best to basically discourage people from smoking.
What's the punishment?
I don't know. I don't smoke.
Yeah.
So I have never challenged the local
The authority. Yeah.
authority. Yeah. I challenge them in other ways.
I see. Okay. One sec. What's up? Okay. Uh-huh.
Okay. Are you ready?
I'm ready.
You can come.
I just need to set up the live stream on Instagram. That's right.
You need to listen to the
The punishment can be quite harsh. Exactly. I hope everybody empathizes and understands. Okay. Let's go. Let's do this. It's going to be flipped over, but fuck it.
Let me say a few words. So Peter Rostowski is our guest today. So we are very happy to have Peter with us. He's an expert on crowdfunding. He's also not just an expert, he's also a founder of a crowdfunding platform, or a platform that serves companies looking for some funding through crowdfunding platforms. So he's gonna say much more about this. I just want to say one more time in front of all of you guys, we are very happy to have you, Peter. So it's an honor to have you. And I hope, and I believe that our students also, they will enjoy listening to you. And we are very eager to learn as much as we can from you.
Listen, thank you so much for inviting me, man. It's been a pleasure.
Yeah, I mean, thank you for accepting the invitation. The floor is yours.
All right. Well, folks, so today's conversation is about the history, virtues, problems, and how to solve them related to investment crowdfunding. As Tolga mentioned, my name is Peter Rostowski. I'm the founder and CEO of Raiseway and director of Crowdfunding Professional Association, among other directors there. Just to give you kind of a context on my professional experience, I used to sell macroeconomic, distressed debt, fundraising intelligence for Preqin, Continuum Economics, some other institutions. And then when I went into the crowdfunding space, I worked for Crowdfund Better. And on the right side, you can see the companies and clients that I've worked with. This is just to establish some credibility that I may know at least something. And this is me at New York Stock Exchange throwing up deuces. So at first, I wanted to start with a conversation about the history of pooling capital in general, right? This is not, I'm not going to say anything particularly revolutionary here, but there is this perception that crowdfunding is something that's very, very new. And in reality, well, we have crowdfunding as we know it, Kickstarter, Indiegogo, GoFundMe, WeFunder. But modern finance uses principles of crowdfunding, if you will, pooling capital, in corporate loan syndications, which are a multi-trillion-dollar market at this moment, club deals, which basically is in many ways venture capital if it's not a single investment. Our taxation policy is that it's still pooling capital. We're pooling capital to build projects together to fund schools and stuff. Insurance companies, banking, government bonds. Famously, the first time government bond was used was for Ferdinand and Isabella of Spain to reconquer Spain from the, I guess, the Moorish conquerors in the, 1400s. And then World War II war bonds, exactly the same principle, right? So again, none of this is new to you. A closer example of what we are talking about when we're talking about like pooling capital for ventures in history is the Dutch East India Company. They had, I was reading about them yesterday. There is this whole conversation about shareholder revolts in there, and they, I tried to find the buy-in price to become a shareholder in a Dutch East India company, just to get in modern dollars, just to kind of suss out like how rich you needed to be to buy in. About $50,000 in 2015 terms. So not quite crowdfunding, but you know. And then the Xinjiang in China was a model of building companies where you could have quite a lot of minority shareholders as well. And this dates back to from 9th to 12th century AD. Famously, the postament of the Statue of Liberty was crowdfunded, proper crowdfunded, you know, small dollar investments, and the statue of Christ the Redeemer. And this kind of gives us a sense that this is the end of the 19th century, this is the beginning of the 20th century. Just gives you the sense that like at that point, small dollar, small check investments and I guess donations start to materialize quite significantly, because in these previous examples, we're mostly talking about very wealthy individuals. Now, yesterday I was sitting in the library downstairs putting this together. It was like an adult coloring book. I don't recommend doing this. I need a research intern because I was ready to blow my brains out. Because I couldn't find a single map of investment crowdfunding in the world. So we're talking about legislation for investment crowdfunding, and there is not one resource that I could go to and say, okay, well, here's all the countries that have investment crowdfunding.
So this is the first map ever created, actually.
I saw something in a few years back, but like this is modern. I was literally checking this yesterday. This is not complete. But I think I got most countries that actually have legit. I went through every region. In some other places I know, for example, I'm in conversation with Eastern Caribbean Securities Authority. They're building, it's in yellow, you can see. They're building a policy set for that. And in Kazakhstan as well, it's in the project. I know that in some countries in Africa, this is being worked on. But this kind of gave me the sense of, well, what are we actually talking about for the market, at least for my project? And in general, how well spread is this? Because as Tolga mentioned earlier in the conversation, it's only been around, I mean, regular crowdfunding, you know, for artists has been around since year 2000 or so. Investment crowdfunding with a very particular set of laws, it's only been, you know, like 17 years, I guess, since the first legit example of this. So this, in 17 years, that's what we have globally. This is the number of countries that have put out crowdfunding legislation. Kind of gives you a sense of the speed of at least adoption by governments. And what I want to be specific about is that when we're talking about investment crowdfunding, we're talking about equity crowdfunding, we're talking about debt crowdfunding. In some rare cases, we're talking about coin offerings under investment crowdfunding rules, but this does not happen often at all. What we're not talking about donation crowdfunding, we're not talking about rewards crowdfunding, so that's Kickstarter, Indiegogo. We're not talking about peer-to-peer lending, which is you have money, I need money, you loan me money. Angel investor club deals, again, I think a good example with AngelList when the regulation crowdfunding law was not there, but that's not proper crowdfunding. And we're not talking about crypto fundraising. Now, I want to kind of look at it from the perspective of investors. And by the way, on the right-hand side, you have the QR code. That's the QR code to the presentation itself. You can ask questions on each of the slides and leave comments there, because this is a huge presentation. I won't be able to answer things on the go. Where did investment crowdfunding, or rather the rules about private companies raising money come from? Well, in many ways, they came from the Jazz Age, the age right before the Great Depression, when quite a lot of fraudsters would sometimes even buy newspapers and put ads in them for investing in oil wells, for example, as we see over here. So this guy is saying, I have $67,000 I've already raised for this project. Give me some more money, and I'm going to make you rich. Next cutout is his office in Los Angeles being raided by federal agents. And what you're not seeing in this cut, I wish I had it here, is that he ends his life by fleeing to Shanghai and then killing himself. So this is this is one of the examples of a fraudster, getting caught. This is yet another one. This is an actual investment document that was used by a match company, a company that was, making matches, that was paying dividends to the investors on the back of the capital raised, not on the back of profits. So they were exposed for fraud as well. And this by no means made the Great Depression. The Great Depression is said to be made by a gigantic private debt crisis, specifically in real estate. But because a lot of Americans invested in these fraudulent enterprises, a lot of Americans lost money. This contributed quite significantly to the very deep, very painful malaise that was happening in the country in the years to come.
I think we don't learn from our mistakes. I mean, this is a Ponzi scheme, right, more or less. And
Yeah.
Madoff was a Ponzi scheme that happened in the early 2000s. So after 100 years, we didn't learn much. And honestly, we had a similar case a couple of years ago in Turkey. A guy basically raised, I think, more than $200 million, and he flee the country. He left, and he went to Uruguay or somewhere. Then he came back for some reason. I don't know. Maybe he cut a deal.
He missed it.
With, I don't know, legislation, whatever. But yeah, we don't learn. I mean, we always have these kind of Ponzi schemes.
And crypto is a great example as well.
Yeah, I had actually in my mind, but I didn't want to say on record that it was a Ponzi scheme. But I agree with you.
Friends, crypto is a Ponzi scheme.
I'm sorry, I don't mean that all crypto, not all crypto. But, okay, but so for 83 years, as a consequence of this, Tolga mentioned in the previous part of the lecture that the 1933 Securities Act was pushed out by, or enacted by President Roosevelt when he got elected. I imagine it was done in conjunction with the famous John Maynard Keynes, the economist that is credited to a large degree with creating an economic framework to get people, to get the United States and the world out of the Great Depression. And the rule basically that the act puts out is that if you're raising money for a private company, basically like if you're raising capital, you should be a public company. You should be trading on an exchange. However, in some cases, you may have the right to stay a private company if you use certain exemptions. So the famous exemption is Regulation D, which allows you to raise unlimited amount of money from only accredited investors. And we'll get to the definition of an accredited investor shortly. The Regulation D has a couple of subvariants. There is some other exemptions in place, but none of these exemptions, with one subvariant of Regulation D, which is that's not easy to use. And none of these exemptions allow you to raise from retail investors. Like if we have people in this room who are not making over $200,000 a year, do not have over $1 million in assets, or are not considered sophisticated financial professionals, which would include me for sure, and I don't know about you guys, we would be frozen out of private investments. And here is the definition of accredited investor, right? So you make over 200 mil a year, you have over 5 million net assets, or over 1 million in financial assets, right? Hard cash. And that allows you to invest on angel list. Now, if you wanted to invest on WeFunder, you don't need to have any of that. You need to be a regular person like you and me, with $100,000 to $200,000 to spare, and put it into a project. So the outcome of this is quite evident, because the pool of people that can do this but can't do that is significantly larger. And one thing that is important to note here is that, well, up until .com, maybe that was okay. Because up until .com, you know, if we look at Apple, Microsoft, Oracle, Amazon, Google, all of these companies IPO'd within about 4, 6, 7 years of their coming to exist. There was a very nice way of raising capital. Oh, and okay, you're fulfilling what the SEC told you. You're going to the public market and you're raising money from regular people by issuing stock in an IPO. The upside for the investors was that, well, none of us in this room would have really needed, as investors, investment crowdfunding, because, well, the upside is huge for public value creation, right? This is the amount of value that's created after the company IPOs, right? So this was created during its, you know, early rise years, and this is it's IPO'd, and now this is the amount of money that public investors are able to make. And then things start to change over here, early 2000s. And this is the outcome of the .com. Because during the .com, and you can see here, right, you can't even see the line of public value on like Twitter or Facebook. That's what it is. So because what happens then is that, sorry, the organization of these slides is a little messed up. So basically, if the stock is dead for you as investors, then for startups, IPO is dead. Because basically, startups stopped using IPO because after .com, it became very, very expensive to use. I looked up the data today. If I wanted to raise money for my company with, you know, with an IPO, I would need to put out like $5 million in cash, you know, up front to auditors, to lawyers, to NASDAQ itself. NASDAQ, yeah. And it became very, very expensive. And the reason it became expensive is because during .com, you know, all of these companies came, they ballooned, they exploded, and the regulators in New York said, okay, we're not going to have that, right? We're going to put some harsh restrictions on this so that you can't mess up the economy like this again. And so they put in quite a lot of regulation, and the number of companies that are valued under 25 million, or rather, that are raising under $25 million went way down, right? The average age of a company that is trying to raise money with an IPO increased dramatically, right? And that's the pricing that I found today. And so if the, at the same time as the public market is starting to contract and stops being as valuable for investors, the private market balloons. The alternative asset space, of which venture capital is a part of, shoots way through the roof. And then we have the VC model coming to market, right? And on the, over here, we have kind of like the amount of venture capital assets under management as it increased over the years, and the, you know, expected return, essentially, right? If you were to IPO, you don't necessarily need to produce these returns for VCs. You know, it depends on how you've positioned your company to your investors, but they don't, the VC, you don't have that time frame limit of like, you know, 10 years of 5 years to invest for VCs, 5 years to offload the assets. There is not the, I mean, I don't know how often the IPO'd companies failed, but it's certainly not the 1 to 10 ratio in the VC space, right? Like,
I think it's around like 5%, less than 5%, looking at different periods in history, so it's not very high.
in terms of the failures?
Yeah, I mean, sometimes it's like less than 1%. In some periods, some decades, it's like 3-4%. It really changes, but it's never like, I mean, in the VC space,
Yeah, 9
out of 10 fails. In public markets, it's actually less than 1 out of 10.
Exactly.
It's much smaller.
So if I had, like as an entrepreneur, right, if I had the option to cheaply get on a public exchange, well, I don't know. Like, I mean, I need to open another department in my company, put a few more shares up, right? I need to buy a house for myself, put some more shares up as well, And now that's not an option currently. And so what happens for startups is that the range of options for fundraising shrunk quite significantly with this. But what happens with startups, in my personal opinion, is honestly not as dramatic as the story that we have with small business fundraising. Because when it comes to small businesses, like a startup fails, right? Like let's say that my company tanks, I go through a few months of depression, and in the meantime, I'm looking for a job. I'm going to get a job. Most people sitting in this class are going to be just fine. If you start a startup, if it fails, you're going to find a decent gig because your university is good and you're all smart people. Everything is going to be fine. For a small business owner, if their shop fails, this means dramatic consequences for their community, for their family, for themselves.
For their employees.
For their employees, absolutely. The reverberations of a small business failure are felt throughout the community. And in every country of the world, this number is maybe fluctuating by 0.9, 0.8. 0.9% of businesses in every country in the world are small businesses. In the United States, that's 33 million, 0.2, and they employ 61 million people, 46% of all US private sector employees. Now, that is in itself an interesting number because it fluctuates depending on which economy you look at. In Europe, where small businesses are said to have a little bit more support, that number is about 55%. So in the United States, it gives you a sense of just how powerful the gigantic corporations are. And just to give you a definition of a small business in the United States, which I think is a little silly, but a small business in the United States has 500 employees or less. So I don't know how small that business is.
So a lot of tech firms worth billions of dollars.
And they're small businesses. Yeah.
WhatsApp was sold for 1.5 billion when it had 9 employees or 11.
I hear stories like that sometimes. I want to be like that. Thank you. And then I looked at the business distribution in Turkey. And 94% are micro businesses, right? That's your mom and pop shops, that's corner stores and whatnot. Then we have small businesses, right? And then you can see the employment stats, that these folks employ about 35% of the workforce. Then small businesses, I imagine it's probably under 15 employees, something like that, maybe under 20. 20% of the workforce. No, and then the rest is basically like over 50% are over 60%, you could say, are small and medium, small and medium businesses. The economic output, though, by the large institutions is gigantic, right? In terms of the what these businesses are doing in this country, it's distributive trade. So I imagine that this is like small corner shops, like food, whatnot. What's this? Transportation, storage, construction, manufacturing, other services. Yeah, I'm imagining that this is the service economy, essentially. Though I may be wrong, and I have not plowed through this data thoroughly. Now, the story that is existing in Turkey and the story that exists in the United States I imagine is very similar. I imagine that this is a very similar story that happens in every country in the world with some adjustments. In the United States, well, we had 26% of surveyed businesses that applied for financing. 74% did not apply for it. Out of the 74% that didn't apply, or rather out of the 100, within that 74 category, only 24 didn't apply because they were just fine. So out of 33 million businesses in the United States, 24 said, we're okay, right? We don't need money. Everybody else, right, 71%, are undercapitalized. That's over 22 million businesses, and probably over, what, 40 million people, employees, workers, owners and workers, do not have enough capital to cover most of the time operational expenses. We're not talking about growth here. I mean, sometimes we're talking about growth and investing in some marketing, but really, right now, most of the pressure comes from operational stuff. And this situation is only getting worse right now because small banks are rapidly disappearing in the United States. I do not know what the situation is in Turkey, but I don't see very many small banks.
We don't have small banks in Turkey. Like, I think the situation is the same in Europe. I mean, US has so many banks. Literally, it had thousands of banks. Now, much fewer, but still, you have a lot of small banks.
Yeah.
In Turkey, in Europe, you have kind of medium-sized and big banks, no small banks at all.
Yeah, and well, I would be curious as to what was happening here 30 years ago, but I imagine the story was the same. In the United States, there was a kind of like, I mean, say what you will, but they knew how to build banks. At some point, until 1980s, when President Reagan got into power, and under Reagan, the financial sector pushed for deregulation. And what happened is that the market share of big banks shot up. They got allowed to, and then under Clinton, they were allowed to use speculative, so use assets from commercial banking in speculation, which exponentially increased their market share. And then they did a second thing, which is called regulatory capture, which is, if you guys watched the All In podcast thing, then they talked about this. The technology that is now required for banks to operate is very expensive. And so a lot of banks could not proceed. They were either acquired, they shut down, and that's basically the two stories. Now, the small banks are most favored by small businesses. Big banks do not want to give loans to small businesses because underwriting a $5 million loan is the same as underwriting a $50,000 loan. Why would I waste my time and the money I spend on my analysts doing that, right? Online lenders, there's a huge fintech kind of a trend nowadays, but they charge very high interest rates, and their terms are not transparent because they're so far removed from the business owner. You know, when it was a small banks, you come to a small banker, you meet them, and there is a community relationship there, but that's gone. And merchant cash advances are time and time again considered by authorities to be basically predators in the financial space, because they will put stuff in the fine print that will, make you lose the business. This is a chart of from Federal Reserve Small Business Credit Survey on the issues with lenders, right? Small banks are these. Look, almost in none of the situations other than high interest rate, small banks are actually these. Yeah, that's finance companies, right? They do not show up as a troublemaker almost at all, right? They're great institutions, but their share has dropped significantly. But even if small banks were you know, like if I love small banks so much, I should be building a company that helps small banks. I'm not building a company that helps small banks because, well, it just so happens that even if you are, you know, even if there is a small bank in your community, there are some issues related to discrimination that are in place, right? Like, I imagine that even if there is a small banker here somewhere in Ankara, and you go there and maybe you are a member of LGBT community, or you're a woman, or you're a minority, or another ethnic group, what's the outcome, right? Are they going to give you the loan? Is discrimination going to play a role? And it's not just the outright, you know, bigotry that sometimes works here. Sometimes discrimination is institutional. You know, you are a member of a community, you have not been able to build up a credit score for some reason because, you know, your family hasn't had generational wealth. Maybe there is some destabilization that happened in your life, war, whatever.
And by the way, it's not just people. Even the algorithms, you know, some banks, some institutions try to solve some of these issues by coming up, you know, with algorithms, by automating these things. And what researchers have found, even those algorithms have biases, and there is a literature now in economics called algorithmic bias. So even the algorithms are coded in a way that, you know, they have biases against, you know, minorities. So
that's right.
Either, you know, majorities like white-owned businesses and things like that. So.
Yeah, so it goes into the algorithms, it goes into the economic situation in your life, into your credit score, and it goes into straight up bias by the banker sometimes. So as you can see, this chart shows you share of firms with financial challenges by ethnic groups in the United States. This was taken in right around COVID, so for Asian people, shoots up. For black people, it's been bad all along. It's been shit. Excuse me. For Hispanic people, also shoots up. Whites, maybe not so bad. And then further digging into this, you know, from minority business owners, generally speaking, they sought way less financing than you know, white counterparts. The white counterparts, generally speaking, sought over $100,000. And that may be a function that they lived in cities or something. But this is a statistic taken of the survey is over, I think, 10,000 respondents across the United States done by Federal Reserve. So this isn't, you know, this isn't amateurs doing this. And then, despite minorities asking for less, they get less. They get way less approved for full or partial financing than whites do. So, I mean, there is all the theory about discrimination, and there is like straight up the just, you know, point blank information on how much credit you're going to receive. And what this produces, I wish we could turn this off because this is like a bunch of memes essentially. What this produces, there is one, thank you. There is one slide that I didn't put in there, is that, well, if the banks are in the financial sector is not supporting small businesses, and we have yet at the same time the McDonald's, the Exxons, the Burger Kings, everybody else, they will not have an issue raising capital, right? They're going to raise a $300 million syndicated loan and open 400 locations. They're going to be just fine. And so if the small businesses are dying without capital access, and at the same time the corporations are having a field day with all the cash that they're able to raise because they can hire investment bankers, they can hire lawyers, them getting or not getting capital isn't a question of whether it's going to happen, it's the question of terms, right? So they dominate the landscape. They come into communities with a higher rent that they can pay, right? They displace with that rent other business owners because they bump the rent price for the neighborhood, right? Starbucks comes in. It's a trend. Like I lived in Brooklyn, and we talked about, you know, the moment Starbucks enters your neighborhood, it's over. It's done. Just like, you know, fold it, you know. And then small business owners are not able to maintain the same rent. Now, what happens then is that these corporations, well, do they pay their workers sufficiently? Usually not, right? They underpay, they lobby the government to keep the minimum wages low. So what happens? They bump the price of the real estate. Residents need to move out. How am I doing on time? Pretty bad. Residents need to move out. They underpay the workers. The worker goes home with a small paycheck, right? They are no longer able to sustain their life fully. Now, if it were a small business owner, right? We're all going to go into that cafe, be that Burger King or a cafe, right? We have a Burger King right outside the entrance of the university. If this was a regular cafe, right? Small business. Every time we swipe our card there, the business owner goes home. Yeah, it's cool. The business owner goes home, maybe invests in real estate in the community, maybe spends the money somewhere else within this local neighborhood community within Ankara. But the Burger King's cash goes to offshore in the Caymans. There's a profit drainage here that's happening, right?
So economic surplus is basically shared by just a small minority who owns the shares of these companies, instead of the locals basically living in that area.
And because the corporations have all the money in the world to pay for tax evasion, small business, it's very difficult for a small business to evade taxes. It is very easy for these guys to do so. So we have underpaid workers, we have profit drainage, and then you can't actually invest in a small business, right? Without investment crowdfunding, you can't bump that small business owner that could have been in that place.
So the game is rigged against...
Yeah, against all of us, really. Because there is a community erosion part. Because besides the business, the economic part of this conversation, there's also the part of this conversation that, I know small business owners in Kash, and I could go to them and I could celebrate my birthday with them, right? There is a communal element to what small businesses do. This company will never be able to do that, right? Their franchise rules are prohibitive towards this. So this is like one meme that just got copy and pasted over this, being like, this is my life, this is our culture, and God help anyone who dares to disrespect it, right? That this is. I've traveled through America a lot, and much of America looks like this, for this very reason. Now, how am I doing on time?
we have around 20 minutes.
Awesome. Awesome. Okay, I'll run through this. Investment crowdfunding, you get the idea now, right? It does two things really, really well. First, it generates equity between communities. Because let's say you're a minority owner, minority, you go to a bank, the bank rejects you, your community will not reject you, right? You may be a female entrepreneur who goes to a bank and the banker, doesn't want to give you a loan. You go to other people in your community, to your friends, they're gonna together pool to help you. That in itself is very, very valuable. And this chart, not the best chart there is, I should really stack them, but it shows that, when it comes to VC funding for minorities, it's like 2% and less than 2%. Nowadays, I think the news cycle is over, and so we're back to investing in white dudes from Stanford. With venture capital, with investment crowdfunding, the trend keeps going. Minorities keep using this, right? For any disenfranchised person, this is a good option. And then the second thing that happens in investment crowdfunding, if you're doing investment crowdfunding, think about the logistics of this process, right? Because I think that freaked me out when I entered in this industry. And I think for many of you, it must feel very confusing as to what does that actually in practice mean? Okay, I have a business idea. Okay, Peter, what do I do, right? What does that imply? You're gonna do a lot of marketing. You're gonna do a lot of marketing, not during the campaign, but months preceding the beginning of your campaign. You're going to be doing a lot of community building. You're going to be going to all the people in your community, reminding them of your existence and trying to, kind of activate them so that by the time that you come and ask them for money, it does not feel weird. Because if you point blank come to someone, hey, give me money, invest in my company, that will feel strange, and you are very likely to burn what's called social capital. This is just an example of what one of those crowdfunding platforms looks like that specializes in small businesses in the United States. It's called Mainvest. They do a lot of weed companies, but also bakeries, coffee shops, breweries, places like that. Look at the number of investors. 188 investors, 163. 93, 93, 63, 66, 72, 76, right? This implies that they've gone to, how many people rejected them when they asked for money, right? Probably quite a bit. And this implies that they needed to build marketing funnels. They needed to improve their Instagram presence. They needed to fix their website, delete their website, do something. Kind of like warm up all of their community relations, because even if somebody doesn't invest, right? Like I have friends, and the reason we're filming this is because this video is going to go onto my company's crowdfunding campaign page, right? So this is a master plan, right? I have friends who are not going to be able to invest in my company, right? They are not in a financial situation to do so, and that's fine. But I still want them to know about what I'm doing because they might be able to tell someone. They might be able to tell someone to invest or to use the product. So it's about building this like movement, I guess, around your business. And because you're going to be doing this, your revenues are increasing. Investment crowdfunding, this is back to this point. Investment crowdfunding bumps your revenues. It transforms your business, essentially. Even if, we use the example of small businesses, but this works for startups and tech companies as well, right? Let's say that you're building something with 5G technology. A painful story for this university, I guess. But if I am an engineer who is raising capital to build a new smartphone that uses 5G technology, I want to go to every supply chain relevant professional in my industry, right? Related to phone building, related to technology, related to telecommunications, marketing, everybody else. And I want to hit them up on LinkedIn, and I want to just establish a connection. Because by the time that I'm raising, I want all these influential people in this very small market to push my company, to push my project internally. They might be working at Oracle, they might be working on Motorola, they might be working on Samsung, whatever, it might be Intel. We want their tools.
We normally finish in 5 minutes, but we will extend it, so you have 10 minutes.
Okay.
To basically complete, so you can
Okay. So we talked about the market sizing here. For startups, in general in the United States, since the inception of investment crowdfunding, there has been 6,000 regulation crowdfunding campaigns for 33 million small businesses, including startups, right? Weird. And most of those were startups, most of those campaigns. So startups are much more comfortable with the concept of investment crowdfunding. Small businesses are not. There's not 250,000 small businesses, 250, right? 0.003% of the market ran debt-based investment crowdfunding campaigns in 22, sorry. So what explains this lack of market? And this is what I really want to hone in on here, that yes, investment crowdfunding for startups, great instrument. Investment crowdfunding for small businesses changes the world. If we make this popularized, if we scale it, if we make it easy for a coffee shop owner not to become an investment manager and marketer, but just know how to make the damn coffee and run a coffee shop, then they can, throw the middle finger to the banks. The same goes for startups that are misunderstood, right? The investors didn't understand you, venture capitalists didn't see the point of what you're building. Great. Focus on your community. Don't focus on this one, person with a lot of buying power. Focus on all these people and get the service to them and make your business a community business. So why are people not using it? Well, because it's costly, confusing, and risky. Costly. Now, one company, our partners, to whom I'm very grateful, Crowdfund Capital Advisors, these are one of the people that lobbied the Congress in Sherwood Nice was part of this Crowdfund Capital Advisors group, which then became Crowdfund Capital Advisors, that lobbied the Congress in 2010 to make investment crowdfunding legal. Now, they run a data company. They estimate that you're going to spend about 5% of what you want to raise before the campaign starts, right? You're going to have to spend quite a lot of money on developing the copy, campaign disclosures, video, all the broad marketing, the legal part, and the accounting is all going to cost you money. And honestly, I think that kind of, I would say that this number here is larger because you're going to spend, yeah, the campaign disclosures part is the expensive part because basically there's very strict rules about what you cannot say in investment crowdfunding. This is not crypto, right? Crypto can come out and say to the moon. Investment crowdfunding, you break some of these rules, and if eventually SEC kind of comes for you, you may not be able to raise capital again. So this is really high stakes situation. You do not want to mess that up. If it costs you $5K or more to start the campaign for $100,000, and an average business in the United States has at any time $12,000 on hand, that's not realistic. People are not going to do this. This is a very high upfront investment to an unclear result. Costly in terms of time. I can honestly tell you, I mean, I don't know how much time I spent preparing my campaign. I've rewritten it God knows how many times. On average, people wait from 12 to 15 months to start a campaign if they're going to start. Because most don't, right? Most people learn about investment crowdfunding and then never start their campaign because logistics. Confusing. This I drew myself some time ago, a few months back. This was supposed to go into our crowdfunding campaign page. As you can see, this, the campaigns just don't start. If you're just thinking about investment crowdfunding, you're going to have to go through all of these different steps. You're going to have to find out which type of instrument you should use. Should you use equity crowdfunding, debt crowdfunding? Maybe you should do, if it's debt crowdfunding, is it a loan or is it a revenue sharing agreement, right? Then you kind of have to get to the funding portal selection. And there's over 80 funding portals in the United States. And most people don't know that most of them are bankrupt and inactive. So, all these steps. And then you actually have to do the legal preparation, the marketing, the community engagement. You have to develop the investment terms and do the testing the waters campaign. There's a lot of stuff that happens here, right? It's too logistically difficult. You can't expect a small business owner to be able to do this. And, there is also like an element of fear in here because people are simply afraid of failure, right? Because they're going to go to all of their community members, basically open themselves up and pray that, that they don't embarrass themselves, that even if they successfully raise, right? Even if they're successful in raising the amount of money they said they needed to raise, which in itself is a fear, right? People are afraid of not raising that money and then that looking really, really bad and sending a bad signal to the community. It shows you as an untrustworthy person, you don't have any friends, right? Pretty scary. Now, in most cases, 72% across the market do raise the target amount. But then, okay, well, you raise the money, that's only when the work begins, Like, you still have plenty of chances to mess up on what you promised to your investors. And that freaks people out, and rightly so. So without all of that, without, assurances that you're going to be successful, without cost reduction, without clarity on the process. The industry has 80 funding portals, and a monthly average is 361 raises per month. Most of the funding portals, right, we have, in terms of the amount of money they raise per month, that's over 80 over here, raising nearly $0 million, right? They're not over 80. This is like, what, 60 funding portals over here, dominated currently by a few companies in the market. Unless the funding portal, so this is to that story, is it a winner-takes-all market, right? Like, unless there is a way for the funding portals themselves to survive through this, because what funding portals did, they, when the Reg CF regulation was enacted, they were like, all right, great, we're going to go to venture capitalists, we're going to raise some money, we're going to put all that money into marketing, into building the platform, and they did, and people onboarded onto their platforms and then never started the raises. So they spent all that marketing money, and the business owners were like, no, thank you. It feels a little scary. I'm not going to do that. And they make money on the back of these transactions, right? Funding portals are unique in that they're licensed by FINRA to get percentage of the raise. Well, that's the situation in the industry. If it becomes easier for funding portals to help their clients with marketing, the industry is going to grow. We're not going to have a winner-takes-all type situation. If it doesn't, that's what we got. This is my company. We don't have any time. I want to tell you about my project, but you can read about it on our WeFunder page. This is not, you can't even invest right now, and I just want to show you what that looks like. But if you've got rich friends, let me know.
Maybe you can summarize it with a few sentences. We have
Sure.
1 more minute left.
Sure.
You can say what it does.
We're not a funding portal. We're a subscription as a service company that takes a person, a business owner, a cafe owner, or a startupper, from the point of, I don't know anything about crowdfunding, to gives them calculators to evaluate the size of their campaign, gives them a CRM system to manage the flow of investors, connects to their LinkedIn, Instagram, whatever, to put all of the investors in one place. You write a little bit about what you are. It writes all of your crowdfunding campaign text with AI. It writes all of your marketing with AI, and it's compliant, right? That's the point, that we're following. We're going to like nail the compliance regulation into this AI system so that people don't go into violation of SEC. They manage the campaign. The platform posts all the social media by itself. All the calendar tools are built in, will be built in. Platform is live, but not like that. And then when you finish the campaign, the tool helps you to report to your investors and keep them active as your brand ambassadors for many years to come. We make money on the subscription as a service, right? With $35 a month for the first stage, Discover Crowdfunding before funding portal application, $125 a month for the campaign preparation stage, $250 a month for campaign execution, and $55 a month for investor reporting. And then we make money on transactions with lawyers. Somebody hires an attorney through us, we get like a 5% fee on that. Ta-da, ecosystem service. Thank you. Thank you so much, man.
Very interesting and wonderful presentation. Thank you. And good luck with your campaign and with your business.
Thank you so much.
I'm very optimistic actually, and I'm very thankful to you for helping basically small business owners in the world basically to solve a problem that they are dealing with.
One thing I wanted to mention. So one of the things that happens with I'm just going to quickly, look. The point of this platform is that it needs to be copy and pastable in every country in the world where investment crowdfunding is legal. I want to do that in Turkey as well. We're, Tolga and I were speaking about somehow maybe involving the US embassy here. Even if not, this platform is copyable if we can write it in the Turkish language and if we can adjust it for the Turkish crowdfunding laws. If there is anyone who is interested, I don't have any money to pay, I'm broke as, I don't know. But if there is anyone interested in working on this, great. Hit me up. My contacts is over here. Take a picture. You can reach me very easily with any questions. I'm very generous with my time when it comes to talking about stuff.
Thank you.
Thank you so much, guys.